In a blow to the stock market, Finance Minister Nirmala Sitharaman proposed a hike in short term and long term capital gains taxes. There are four key changes you need to understand in the capital gains taxation regime. Number one, short term capital gains on certain assets will attract 20%, up from 15%, and all other on financial and non financial assets will be taxed at income tax rate applicable. Number two, hike in the limit. Capital gains exemption limit to rupees 1.25 lakh per year, up from rupees 1 lakh. Number three, tax on long-term capital gains on certain assets will be hiked to 12.5% from previous 10%. Number four, unlisted bonds, debt, mutual funds will continue to be taxed at the applicable tax rates. So let me break this down for you. For listed financial assets, the holding period to qualify for long term capital gains has been kept at more than 1 year. If you sell a financial asset within a year of purchase, it's considered short term, and the tax rate on the profit is 20%. So, in a sense, holding an investment for a longer period now attracts a higher tax, while short term gains on certain financial assets continue to be taxed at a higher rate of 20%, while that on other financial assets and all other non financial assets shall continue to attract the applicable tax rate. Long term gains on all financial and non financial assets will attract a tax rate of 12.5%. Listed financial assets held for more than a year will be classified as long term, while unlisted financial assets and all non financial assets will have to be held for at least 2 years to be classified as long term. Now, the higher rate of 12.5% will apply to all capital gains accrued over the years, not just on your current investment. Experts say this effectively increases an investor's tax burden by 20%. The union budget also proposed to increase the exemption limit for capital gains on certain financial assets to rupees 1.25 lakh per year. While there are no major benefits for taxation of long term capital gains, there is some benefit for the taxpayers dealing with specific financial assets where the proposal is to tax such short term gains at 20%. Following the development, Sensex fell over 800 points and Nifty plunged 350 points. But before we know the impact of the change, what exactly is capital gain tax? Capital gain tax in India is the tax on the profit earned from the sale of capital assets, such as stocks, bonds, real estate, or other investments. This tax applies to both individuals and businesses. In 2018, Finance Minister Arun Jaitley introduced a 10% long-term capital gain tax on gains exceeding rupees 1 lakh without providing indexation benefits. Speculations about a potential hike in capital gain tax had been swirling well before the budget announcement. It seems that those predictions have now come true, leaving investors and market participants in a frenzy. Social media is buzzing with debates about the potential impacts of these changes. So, how does this affect you? As per income tax rules, when an individual sells a capital assets, they earn capital gain or loss. These capital gains or losses are categorized as short term or long term depending on the nature of the capital asset and the period of holding specified for the asset for the purpose of this categorization. For instance, if the equity shares listed on a stock exchange are sold before 12 months, are completed from date of purchase, then capital gain or loss will be categorized as short term. If the listed equity share are sold after completion of 12 months, then capital gains or loss will be categorized as long term. On the other hand, for unlisted equity shares, if sold before 24 months, the gain or loss will be called short term. If the unlisted equity shares are sold after 24 months, then gains or losses will be long term. Do let us know what you think about the changes introduced by the Financial Minister Nirmala Sitharaman on the tax on capital gains. I am Deepthi Rao. You are watching India Today, SoSouth.